Nonetheless, March 17th, we are almost through Q1, which I thought would be a nice bullish quarter to get us started off the year. Not exactly what we got with February being a horrible month, and the first week of March being pretty ugly as well. Obviously, last week we got a little bit of relief on Friday, but still, pretty dicey out there. We'll talk about that today. We're going to cover a couple quick things, where the market's at, where I think we could be headed, a couple of stocks that I think are interesting right now. And then I'm going to talk about what I think is probably you know, the number one strategy right now to kind of be focused on. So, yeah, we'll get right into it. Um, Happy St. Patrick's Day. Yes. I always forget that it's St. Patrick's Day. Actually, funny story. I am a little bit Irish, but I'm one of those people who I hardly remember that it's Christmas until like the day before. Even with everything going on, I'm just got a million things going on. I always forget. So speaking of St. Patrick's Day, on St. Patrick's Day, about 13 years ago, I planned a lovely date for my now wife and I, where I was going to propose. So we went to downtown Pittsburgh. We went to go up to the incline plane. If you guys know, there's an incline that takes you up to the top of Mount Washington there. It's a beautiful view, and there's some nice restaurants up there. And so I planned this day because it was a weekend and I was off, and I thought, it'd be a great time to, take her out and propose. And it never occurred to me that it was St. Patrick's Day. No idea. Never crossed my mind. So even, as we're planning and, we got ready and we go out and drive it to downtown, which is about an hour away. Still never even crossed my mind. We get down there and then we get on the incline. And it's not like super late. It's like 6 o'clock. And I realized that everyone around me on this incline, like these 15 other people, are totally wasted. And I'm just thinking, like, what is going on? Like, why? Like, sure, some people have some drinks on a Saturday evening or whatever it was, but like, it seemed a level above. And still, I'm trying to like put the pieces together. Like, what is going on? And then very slowly, I don't know why it took me so long. I'm noticing, that there's green around and people have the clover patches. And oh my goodness, it's St. Patrick's Day. I'm trying to propose to my, future wife with green beer and wasted people surrounding me at every turn. So I ended up having to we get up there, chaotic scene. I ended up having to pull an audible and change my whole plan, cancel the dinner reservation at the last minute, and get back down and go somewhere else, find a different area. Ended up doing it kind of on the Riverwalk in Pittsburgh instead of at the restaurant, but it all worked out, and she still said yes despite my horrible planning. But yeah, that gives you some indication of how good I am at recognizing what's going on, kind of in the broader scope with holidays and things of that nature. So that's your fun tidbit about Nate for the day. Okay, let's. Pete said 10 kids later. Only seven, Pete. Only seven. Let's not get ahead of ourselves. All right, let's jump into our session for the day. Move this up, and now we are doing this at a different time. Sorry for pulling the audible. Hopefully you guys got the text and the messaging there in advance, so you knew. But a little last minute update. I actually moved our session today because of what Jack Carter has going at 1. I didn't want to interrupt that. And I'll comment on that a bit more later because it ties into the number one strategy that we're going to talk about. But that's why we're live at 12 today. And I'm assuming in the future we'll be back at 1:30. So just keep that in mind. All right, let's jump into where the sectors are at for our kind of head start. In other words, what's the immediate open and what did the weekend and the day so far do with our sectors, what's winning and what's losing. And as you see, most of the sectors actually trending generally in the right direction. Now we have some that are still underperforming a little bit, but generally they're mirroring each other. Now this is quite different than what we've been talking about in recent weeks, especially over the weekend, where we've seen big divergences, some sectors gaining a ton of ground, others losing a lot of ground, really just kind of separating. Here, we're seeing a pretty general consistency across the board. There is one exception that I want to talk about here in a moment, But we're seeing, real estate move up. We're seeing energy continue to gain a lot of traction. Staples bounce back up. Thankfully, that's a sector that I've had a decent amount of weight in, so I'm glad to see that kind of bounce back up. And then we're seeing some of these sectors like health and communications and technology kind of end up in the middle of the pack. Now, technology has been jumping up and down. We'll dive a little bit deeper into that in just a moment. But overall, it's really consumer discretionary that's continued to get beat up and take the worst of the hit. Really was ugly for most of the weekend and then actually bounced back up quite a bit here just to be somewhere in the neighborhood of break even when I took this right around 11 or 11:15 a.m. But as we'll talk about, kind of just continuing to beat a dead horse here a little bit, I think these middle tier sectors like health, like energy, like consumer staples, make a lot of sense to trade right now. Technology is going to be super wild. Communication is going to be super wild. Real estate is probably going to be, fairly uh, dependent on liquidity and just what interest rate announcements, things like that go on. Utilities has been super unreliable lately, which is kind of interesting. So it's those other sectors that I've focused on the most and will continue to do so until we get some more stability in the overall broad market. But again, nice to see energy kind of continue to move because before, really every time we had an outsized move on energy, we had kind of pulled back. And it shows that maybe we are getting a real rotation. We are getting a true kind of risk off rotation here with more money piling into safer sectors, specifically energy. Gold obviously made all-time highs. And so we're maybe starting to see a legitimate rotation in there. And I have one other piece of information that might be worth noting as far as energy and just the safer risk off assets are concerned. All right, let's talk about our weekend trade. That was on PGR. Actually, even popped a couple more cents since I took this update, about another 50 cents higher since then. But this was progressive. We took the trade right here on Friday. If you guys were in that trade, give me a quick yes in the chat if you jumped into the progressive trade on Friday that we put in right around 283.50. Got a really nice drive today all the way up, hit over 290. Our line in the sand on this trade, as you can see, is the white line here. So 287.50 is the line in the sand that we put on this trade. Had a really nice pop. Obviously, on the weekend trade, we're basically giving it a week to make that move. In this case, we made the move in just a couple hours of market time. Now, you might have been filled on your target already, or you might just be in the range of your target. But either way, we are now above that line in the sand where we should get some time decay working on our behalf instead of the time decay being, what we have to overcome, which is always a good place to be. In other words, if Progressive just sits here at 289 over the next couple of days, it's going to add value, add value, add value to our trade. That's one of the big benefits of trading with spreads, that once we get over this line in the sand, the odds flip into our favor and all of the time decay starts working on our behalf. So I see John got in the trade, Frank, Kim, Phil, Jack, Sally, Pete. Okay, beautiful. So a lot of you guys jumped into this one. Really great trade. So that's two in a row, obviously, that really worked out quite nicely. Again, I don't know if everyone hit their target on Progressive yet, but it's above the line in the sand, above kind of our target price here, where the profit should be continuing to work in our favor as long as it holds steady here over the next couple of days. But obviously, XLE was a big winner. Before that, we got XLC that jumped up over the gap. That one didn't stay as well over the week, so we took some profits early on XLC. We had a loser before that. I think we took a IBIT or a coin trade before that didn't work out really well. But then before that, we had a couple other nice winners. So the weekend trades have really been quite profitable for us over the last 5 weeks, even in spite of this crazy collapse. Speaking of, I'm curious what you guys' feedback on this. Graham, who I think actually logged in earlier, has been pushing me super aggressively to do like kind of a beta test or like an early launch of a weekend strategy that I've been working on. Obviously, you guys know I've been trading on the weekend more. One of the things I discovered in some of my testing for a totally different strategy, I didn't even mean to, was how extreme the premiums are for the weekends. And one of the things that really jumped off the page that I'm guessing most people don't know is that while Mondays tend to be the most negative day in the stock market, and weekends in general have a little bit of a negative bias, it's actually because, for the most part, I mean, I'm generalizing here, but for the most part, it's because a few weekends over the course of time have been horrifically negative. For example, you take Black Monday out of the equation, which is a 20% drop. And just that alone turns Monday basically into a break even or a slightly positive day, literally just one day 40 years ago. And then if you kind of look at that over the course of, say, like 10 different weekends over the last 10 years that have dropped 4 and 5%, if you remove those, you actually get a pretty good performance over the weekends, which is something I did not realize. I knew the volatility was higher, but I didn't realize that over time, the volatility actually does move in the bullish direction. It's just that these couple of trades over the weekend really pull you in a deep negative overall net return. And so if you're just thinking about that from a trading aspect, you would happily lose 10 out of, 180 trades or 220 trades or whatever the total weekends were. Go ahead and take those as losers if you're winning 200 other trades. I know I sure would. And that's pretty much how the data plays out. You can see here, this is a real equity curve from a weekend strategy where basically I do just that. Cap the loss. If it does drop 5%, I don't care. It's just a normal loss. But if it bounces up or is break even, it ends up being a win. So the question I have for you is, should I try to ramp this out and do like a beta group and start doing the official weekend trades in a service much more quickly than I was planning on it? Graham is pressuring me to do this ahead of time because of where the markets are right now and the fact that weekends have actually outperformed the week. And so I might do this if I get enough feedback from everyone. I think we're going to post something kind of midweek this week. And if I get enough positive feedback, I'll do kind of a quick and dirty group, kind of like what we would call like a red carpet on this ahead of time, much before I was originally planning on it. Because, you guys know, I've been telling you for forever, I have so many more things I want to focus on, so many more strategies I want to show you. But I feel like I've been doing it so quickly. We've just recently been talking about two-way options. I've had so much on the plate that I don't want to overwhelm you with different strategies and ideas. So I obviously want to do it, within reason. And I want to make sure that everyone's excited as I am before I do something new. So, okay, so you guys are saying yes. All right, well, maybe we'll do this kind of ahead of schedule then. Open it up for a very short period of time, kind of bring in a group, and then still do it, kind of more officially down the road. So again, I've been getting more excited about this as I've kind of uncovered some of the secret sauce, I think, behind why most weekend strategies actually end up failing. But there's actually a ton of opportunity. And it mostly has to do with the extra premium you can get by using volatility to your advantage instead of avoiding it, which is pretty much what I've done up till recently. You guys have been noticing, obviously, I've been doing these weekend trades. It's exactly that reason, to kind of take advantage of the volatility instead of avoiding it, which is what I had done previously. And I basically said, I never want to trade weekends. And now all of a sudden thinking, hey, there's something to this weekend anomaly. So I'll keep you updated on that as we go along here. All right. So let's take a look at the S&P 500. So the S&P 500, in my opinion, is basically in the definition of no man's land. We're right around these previous tops, which I think was the level, right around that 560. In my mind, I would just draw a line at about $560 on the S&P and try to get a clear weekly close on one side or the other as your best directional bias. I don't think you're going to get a whole lot better directional bias than right around this 560 level on the S&P 500. The problem is we got a big move below that midweek last week, and then we ended up shaking right back in between the zone. And now, I mean, by the way, the week before, it looked like we were going to try to get below some of these levels, and it did the exact same thing. Now we open with a very slight positive bias, but still in this range. So this is what I would consider the definition of no man's land. And that's why you're going to hear me say over and over and over again, while we're in no man's land, I don't really see a big benefit of trading big directional bullish or bearish moves. I really see trading volatility as the key here. Because when you don't have a good directional bias, I just don't see a reason to take the market on and try to predict it, especially in the chaos that we've seen lately. Now, maybe you're braver than me and you really feel strongly that this is a correction back up. We're going to make all-time highs here. Maybe you feel strongly that this is just a retest and we're going to make new lows. We're going to head down to 500. I don't feel strongly enough either way to make those big, strong directional plays. So for me, this is very much a no man's land, and why I keep saying, hey, as far as I'm concerned, we should trade volatility itself versus trying to pick direction and play that. Again, this is the S&P 500. 560 is the number for me. I would look for it on a weekly close. Heck, maybe even we'll get a monthly close here in March and get some directional bias. But until then, I don't think it's it's super profitable to try to pick that direction. Now, one thing is interesting that I've noticed today, and we kind of talked about this happening on Friday, but it seems to start to be cemented today. And that is that the Mag 7 is still being hit, but it now feels more rotational than just leading the pack. Okay? So we've seen the Mag 7 take huge hits. Obviously, Tesla, chief among them. I'll talk about that just in 1 second here because I think Tesla is an interesting case study. But in general, we've seen the Mag 7 take a lot of hits. Now, those hits so far have just been leading the market. In other words, the Mag 7 is getting crushed and the entire market is following. They've basically been a leading indicator for where the market is going. But right now, and actually going back to Friday, it's starting to seem like while the Mag 7 is still going down, that it's more rotational. What do I mean by that? Well, I mean that the losses and the liquidity that we're pulling out of the Mag 7 actually seems to be going to other places now for the first time here in weeks. And you can see that even just the QQQ, which is heavily, heavily tied to the Mag 7, is even still diverging. Okay, so the QQQ, which should really pair with the Mag 7 almost no matter what, even that is diverging, which is a great example of what I'm talking about, where we're seeing, I think, some real rotational moves here. Now, obviously, we're seeing gold go up. We're seeing energy go up. We're seeing some utilities and basic materials stabilize. We're seeing staples continue to bounce. And we're even seeing things like communications and the rest of the tech sector stabilize and even go up a little bit while the Mag 7 continues to go down. As a matter of fact, I haven't looked at it in the last couple of minutes, but the Mag 7 was down over 1% last time I looked, while the QQQ was break even, which is a shocking divergence for the NASDAQ and the Mag 7 because they've been hand in hand for, again, long time, but specifically all of February and the first 10 days of March, where the Mag 7 was leading the pack, but the QQQ was certainly following the Mag 7's lead. Now we're getting the first real rotation. If you look at this, this actually goes back to early March, where they're trailing, they're staying, and the QQQ has kind of sneakily been pulling away since this point here, where the Mag's made a bigger drop. And over that time frame, the QQQ is actually up 0.66%. Again, not a major move or anything, but up positive, while the Mag 7 is down negative 1.4%. So that's an over 2% divergence in that index versus the Mag 7, which we really haven't seen. So this, to me, is an interesting hint that we might actually be nearing a floor, or at least a potential, or excuse me, at least a temporary floor for the broader market. Because it seems like we're not just pulling money and panicking at this point, but we're actually moving and rotating money into other stocks and sectors. Netflix, obviously jumping quite a bit today, really ripping and holding the cues. Gold making all-time highs. Like I said, some of the other sectors like energy, risk-off sectors. I think energy and gold are the best use cases for the risk-off rotation. And if that's the case, then it really opens up some interesting possibilities that, we might actually be getting a real rotation here from the highest concentration of wealth, which has been the Mag 7 for the last couple of years, into maybe some undervalued or just some safer assets that are not represented in the Mag 7. Now, speaking of the Mag 7, one of the questions I have is, when is it time to buy Tesla? All right, I love your answer. I'd love to get your answer in the chat here as well. What do you guys think? Now? Never? Or a little bit deeper? A certain number? What do you guys think? Before I go to my next slide, Give me your feedback here. Now, never, deeper correction, waiting for momentum. What do you guys think? Okay. But okay. Wait. Okay. Becky says maybe now. We got okay, let's see. So Stacy says never. Phil says never. Sally says not now. Ed says never. Frank says deeper correction. Daphne says wait for it to get going in the right direction. Buck says at 150. Whew. Deeper yet. Okay. Ken says never. Dwayne says now. Kim says waiting for a bounce. Becky says maybe now. Davin says 220. Jack says deeper correction. Claudine says never. Lanny says never. Okay. Wait, never, later. Not until the whole market turns around. Okay, Jim, interesting. Tom says now. John says wait. Savannah says 184. Okay. Not now. Okay, interesting. I was curious what the market sentiment is. We got more nevers than any response, which I did not expect. More people said never than any other answer, which I did not expect. Well, the reason that Tesla's interesting to me is that it's always been a stock of major pullbacks. Okay, so it's not like, some of these other stocks that I like, LLY and Apple and Progressive, where the pullbacks are really rare. And as long as it gets 10 or 15% pullback, you feel comfortable buying it. I mean, Tesla is really a stock that has had historic major volatility. 49% pullback back here in 2016, 62% here. I think that was 2018, 42% here, 72% here going from January to January 2023, even a 54% pullback right in the middle of the crazy rally to all-time highs. And then now we're in about a 52% pullback currently. So in this, 50 to 60% range, I personally think that Tesla gets interesting. Now, don't get me wrong. When I say interesting, I certainly mean high risk interesting. But it does get interesting to me once we get into this 50, 60% pullback, just because the sheer upside of Tesla is so extreme. I mean, Tesla could drop down to $100, but it could certainly flip to $600 just as easily and just as quickly. And so Tesla becomes really interesting to me here. Now, there's a couple things that I think are worth noting. Number one is just the technical aspect, right? Tesla is a stock that has consistently made these super aggressive pullbacks and then figured out ways to make all-time highs, right? So just from a technical standpoint, just from an opportunity standpoint, I find Tesla very interesting. But obviously, Tesla has had a major change of sentiment. That has to do with one, Donald Trump, most importantly. I mean, I think hard to overestimate the impact that Elon and Trump have made as a pact together, where now, Tesla's entire consumer base has to be okay with him being a Trump advocate and essentially, a Republican politician. I mean, at the end of the day, that's essentially what he is. Now, we could go super deep down a rabbit trail into what that means and what he's actually doing, because the Doge thing is not actually all that Republican. In a lot of ways, it's fiscally Republican. It's fiscally, budget focused and cut focused. But in terms of where he's actually stepping, it's not actually like socially conservative or any of those things at the end of the day. So it's kind of an interesting spot where he finds himself. Again, certainly fiscally conservative, but he's tried to run Tesla fiscally conservative as well. He tried to run Twitter fiscally conservative way before any of the the political stuff was out there in the open air. So that is actually not a major divergence for Musk, even though again he's now linked with Trump, and so certainly the optics of that are what they are, and there's no changing that. But it is kind of an interesting balance in terms of where he finds himself. And so the question there is, what percentage of his customer base is lost forever? What percentage is temporarily lost that might come back? What percentage is actually added on now that maybe was not, a Tesla fan before and now will become Tesla fans? Where on the balance does that lie? And then, of course, what I think is the most intriguing aspect is, are the robots for real? Are the robots going to be, a trillion-dollar potential industry that Tesla is one of the first or the first market leader on, and how much market cap does that actually raise and increase for Tesla? I also think it's worth noting that because of the Trump conglomerate with SpaceX and other ventures, that Tesla can probably backdoor some revenue if they want. They could do some deals between companies and probably backdoor some revenue if they want. Now, the interesting thing for me here is that I've been calling Tesla shorts uh, for almost a year. Of course, I was wrong when they got this massive run up. I never projected that Elon would be such a huge part of Trump from a campaign and an ideological standpoint, and that he would help him win, and that win would then give so much momentum to Tesla stock. So that was not part of my radar for where the stock would go. I was just looking at it as I think that the electric car industry is now overpriced. Basically, I think that the electric cars should now be priced like any other automotive industry from a PE ratio and that kind of thing, versus being priced into some major tech company. Because now that every car manufacturer can produce an electric car, why would we price Tesla as some incredible tech company when what they're producing is, at least in broad terms, similar to what every other car company is now producing? Well, now he's tried to remedy that by producing the robots, of course, which I think is a smart move by him, because he needs Tesla to be priced like a tech stock. If Tesla drops down to a 10 PE, like Ford or GM, this thing's going to $60, right? So he needs it to be priced like a tech company. And so I think he's tried to pivot and do exactly that with the robots. And maybe that's real. I don't know. But that was the main reason that I was quite bearish on Tesla. Two reasons, really. Number one, that the PE ratio is that of an NVIDIA, not of a Ford, and it should be somewhere in between. And number two, that so much of their net profit is still based on government credits. And if those start to dry up, then the big margin for Tesla is going to dry up as well. Because if you see what Tesla sold from a vehicle standpoint versus their margins and their profits, it's extraordinarily high. The reason it's so much higher than Ford or Toyota or any of these other companies that are in the same, just ballpark of vehicle sales is not because they make the car so much cheaper and sell it for so much more. It's because of the government incentives. That's what gives so much extra margin in Tesla. And so for all those reasons, I've been negative on Tesla. But now I think with the correction, it's interesting because the ratio flips in my mind a little bit, where Tesla's upside is once again quite extreme. If the robots thing works out, if Musk puts some interesting deals together with his conglomerate that buffers Tesla's margins, if the government continues to buy Tesla vehicles, because remember, that was under Biden that they put in billions of dollars of orders for Tesla vehicles. That wasn't under Trump. So if Trump renews or increases that, that's a new, massive amount of subsidies and margin that Tesla will pick up. And also, I think the question is maybe even more simply, is this 50+% correction representative of Tesla's market share in the world? In other words, did Tesla really lose over 50% of their customer base? Did they really lose over 50% of their upside, their potential? Well, I would argue no, because even if you say that Tesla lost 50% of its customers during this whole, political thing. So let's say that Tesla lost 50% of its potential customers during the last year by aligning with Trump and doing everything like that. I think that's pretty high, but let's say they did. Well, that factors in 0% of gained customers from that political move, which, keep in mind, over 50% of the people voted for Trump. So you got to assume that Tesla's picking up some level of buyers. Now, maybe the average Republican doesn't align as much with the average Democrat. That's fine. I would readily agree to that. But you can't factor in a 0% customer increase from that side of the aisle, right? You have to factor in 20% or 30%, something that's going to kind of net average, say that Tesla lost 25%. Well, that still means a 50 to 60% correction is an overcorrection from Tesla. So for me, all of that kind of theoretical talk, just to say this, I think the risk reward is now positive for Tesla. I thought it was one of the worst risk rewards at 400. I think it's one of the better risk rewards now in 220 or 200. So especially if Tesla were to hit 200, I think I become a buyer, not because I'm necessarily all in on Tesla and the potential for Tesla to win the robot race or to be the best electric car manufacturer, although they certainly are, and they certainly have an advantage in both of those. But strictly from a risk reward ratio, I think Tesla at 220 or 200 bucks is about as good of a high risk reward scenario as you'll get, and I think becomes a clear, kind of overcorrection at that point. And we've seen Tesla do that over and over again. So it's not like once Tesla takes a hit, it never recovers. I mean, we've seen it take multiple hits like that and have incredible recovery. So the question is, when is the time to buy Tesla? For me, probably 220 or 200 becomes the time to buy Tesla, not because it's a quote unquote great stock, but because the risk reward there, I think, becomes overwhelmingly positive for Tesla. All right, moving on. I spent more time on Tesla than I thought I would today, but just wanted to give my notes because I think it's probably one of the most interesting stocks in the market. Okay, PGR, still my number one stock. This is the weekly chart of PGR. You can see it's one of the best stocks in the world. Why do I love PGR, Progressive Insurance? Because it's a winner in both bearish and bullish markets. It's a winner when things are risk off. It's a winner when things are risk on. Very few stocks meet that criteria, and it once again has catapulted to all-time highs. Historically, when Progressive makes all-time highs, it continues, and it continues to build momentum beyond that. So I'm not afraid to trade Progressive at all-time highs. I think it's one of the most enduring stocks that we have. If things get very negative in the overall economic landscape, which you could argue they're already pretty negative, one of the reasons that Progressive tends to hold up so well is because people are required to have insurance, right? So there's not a lot of other industries where the government is mandating you to pay a certain bill to a private company. But you can't take your car out on the road without auto insurance. So the government is literally mandating you to pay a certain bill to a private company. Think about the advantage that is when things get tight, right? No, there's no government mandate to pay your Netflix subscription. There's no government mandate to buy organic meat. There's no government mandate to upgrade and buy a Tesla. There's no government mandate to buy the newest iPhone. But there is a government mandate to pay your insurance bill. And so Progressive and the other insurance companies have a huge advantage when things are tight over just about any company because of that mandate. And so that's one of the reasons that I think Progressive is so steady, such a great stock. Now it's also become somewhat of a self-fulfilling prophecy where when things get tight, people recognize that Progressive is such a great stock, even in difficult times, and it picks up volume and liquidity while other risk-on assets start to fade. And yet, when the market picks up and is very bullish, Progressive still tends to outperform. Again, one of the very few stocks that do that. So Progressive still my number one stock, and we're trading it actively like we did on the weekend trade, but I'm also holding it, and I think it's a great stock. But that said, picking stocks is not my number one strategy. I alluded to earlier. The number one strategy for these markets, in my opinion, is still trading volatility directly. Okay, so I said it at the beginning, I'll say it again. I really believe that the best thing that you can do right now is trade volatility directly. Now, there's lots of different ways to trade volatility directly. We talked about two-way options at the time last week, several other ways, but one strategy to consider, and the whole reason we moved our meeting today, is Jack's Bitcoin Cash method. Why? Well, because in a volatile market, Bitcoin is a volatility king. Okay, so Bitcoin has as much volatility or more volatility than almost any other instrument out there. And because of that, if you want to trade a volatility based strategy, well, you can trade Bitcoin incredibly effectively because it's so volatile. And that means anything that you're trading that gets you extra premium, extra cash, extra opportunity based on volatility, well, Bitcoin is going to be an incredible opportunity. This, by the way, is a $656 trade I made using Jack's method on Bitcoin. And the cool thing about this trade is that Bitcoin obviously didn't go up and this still cashed in. So the core thing here with trading volatility is that it's not directional, right? That means Bitcoin can go sideways, can go up, it can go down, and that volatility is still playing to your advantage. Now, here's one that Jack did. I'm not going to share all his private details, but he did this on a relatively small amount of capital and made $2,786 on a volatility play on IBIT, which is the Bitcoin stock. So I think this is pretty incredible. If you compare this to other volatile stocks like Nvidia, like Tesla, Google, Apple, like all these stocks, they really don't hold a candle to the volatility that you can get here from IBIT or from Bitcoin, which is what Jack is trading. And so for me, this is definitely a strategy to consider. As a matter of fact, here's what Jack sent to us in our private group. I guess this was about a week and a half ago. He said his new goal for IBIT, again, that's the Bitcoin ETF, the iShares, is to make $51,840 over the course of a year using 1,600 shares. So Jack's goal here is to make almost $52,000. And the cool thing is that it's not based on Bitcoin going up. Now, if Bitcoin goes up, it adds an extra layer, but it's not based on Bitcoin going up. It's literally just based on the volatility premiums there for IBIT, which are insane premiums. Okay, so this is for me, when you're talking about volatility, I know some people already asked in the chat, how do I trade volatility? Well, to me, this is one of the best opportunities simply because it offers the most volatility, which means it offers the most premium. So I moved today's session specifically so that we could attend Jack's session at 1 o'clock. So if you want to jump on from one Zoom room to another Zoom room and join the session with me, I'm going to jump on. Again, really, it's a very simple idea for me here. Volatility is high. I believe trading volatility is the best thing you can do right now. Jack's, Johnny on the spot with trading Bitcoin because the volatility is so high. So I'm going to jump on from this Zoom room to that Zoom room. And if you want to join me, I'll drop a link here and you can do that. Let me go ahead and grab the link. I'll do that right now. And that way you guys can join. Okay, Dakota beat me to it. Thank you, Dakota. So if you want to join, you can hit that link that Dakota just dropped. I will drop it again in here as well. That will open up the new Zoom room. I'm going to hop over there in about 2 minutes. I will see you over. And again, if you're interested in trading volatility, if you want to know specifically how do you actually take advantage of the fact that Bitcoin is so volatile, just click that link. It should open up a new Zoom room for you. You basically click yes, close this Zoom room, open that Zoom room. We're going to get started there in about 15 minutes. And Jack's going to walk you through what he calls the Bitcoin Cash Blueprint, which is all about using volatility, using the extreme premiums available inside Bitcoin to take advantage. In his case, targeting over 50 grand just on volatility. Again, that's not Bitcoin going up. That's literally just playing the volatility, which is exactly the kind of strategy that I'm going for. So I'm going to be following Jack's blueprint. I've already done it the last couple of weeks. Already made some nice cash doing it, even as Bitcoin has not gone up. And I'm going to be continuing to do that. If you want to see how to do it, just go ahead and click that link right there in the chat. That'll open up the new Zoom room, and I'll see you over there in a couple minutes. Again, that's right in the chat there.